Welcome to the deep dive. Today we're really getting into a specific investment framework for the Indian market.
Right, a very structured approach we've been looking at.
Exactly. The idea is to unpack this catalyst-driven Techno-Funda strategy. It's supposed to help filter for those, high potential stocks.
And it's based on quite a comprehensive report and, well, a lot of market data.
So that's the mission for today's deep dive.
Yeah, and what's interesting is it's not just rules, it's more like a system, something repeatable.
Okay.
It blends specific event insights, qualitative thinking,
Yeah.
and technicals. The aim is really to get beyond just chasing headlines, find real long-term spots.
Okay, let's break that down then. The core framework, it starts with the why, right? Screening for specific catalysts.
Precisely. Things like post-earning announcement drift-peed. That's a known factor.
Right, where the stock keeps moving after good or bad earnings.
For weeks sometimes. Or you look at demergers, big shifts in shipping, or even like huge new orders announced by a company.
These aren't just random news items, they build a story.
They create a compelling narrative. Exactly. Something that can genuinely drive interest.
So that's the why. What comes next? You mentioned qualitative checks.
Right. This is the what and how long part. Crucial filters. You have to ask, okay, why is this growing? Is it real?
Uh-huh.
And then, can it last? Like for 2 or 3 years?
Give me an example.
We'll take a big order. Say for Larson & Toubro. That gives you actual revenue visibility for years. It's tangible.
Not just a one-quarter bump.
Exactly. Or a demerger, maybe like the potential one at ITC. The idea is unlocking value, letting businesses focus. This step is key to filter out the noise, Separate real value from just, well, news.
Okay, so we've got the why, the catalyst, and the what, the sustainable story. But timing is everything, isn't it? How do you know when to jump in?
Ah, good question.
Yeah.
That brings us to the technical filter, the when.
Okay.
The rule here is only invest if the stock is in stage 2 above its 200 DMA.
Stage 2, Stan Weinstein's concept.
That's the one. It means the stock's in a clear, confirmed uptrend. Price is consistently over the 200-day average. It shows momentum.
So you're not trying to catch a falling knife, basically.
Exactly right. You avoid buying into what looks like a good story while the price is still tanking. You wait for confirmation.
And risk management, how does that fit in?
Very disciplined. You start small, a 1% pilot position, just testing the waters.
Okay.
If the story plays out, if the stock behaves as expected, then you scale up, maybe to 4 or 5% of your capital.
And getting out?
Also disciplined. Initially, the rule was a simple, close below the 200 DMA, protect your capital.
Okay, this framework sounds pretty robust already, but you mentioned the report suggested some ways to make it even better, enhancements.
Yes, exactly. 2 key refinements really stood out. First, tweaking that exit strategy.
How so?
Well, that simple, close below the 200 DMA can sometimes cause whipsaws. You get shaken out of a good stock just because it dipped briefly, then it bounces right back.
Ah, right. Frustrating.
Very. Think about Vedanta. Say, back in July 2025, it was chopping around its 200 DMA. A better signal, the report suggests, is waiting for a consecutive weekly close below the 200 DMA.
Weekly close, consecutive. Okay, that filters out more noise.
It helps you stay with the strong trends longer, hopefully.
Yeah.
Reduces those premature exits.
Makes sense. And the second refinement.
Adding a proper fundamental health check and looking at valuation.
So momentum is good, story is good, but the company needs to be financially sound too.
Precisely. You don't want a great story built on shaky foundations. So after the qualitative checks, you run a fundamental health check.
Like what specifically?
Screen for debt-to-equity ratio under 1.5. Make sure it's not overloaded with debt.
Uh-huh.
And return on capital employed, ROCE, ideally above 15%. Shows efficiency, that it's making good money on its investments.
And valuation. PE ratios.
Yeah, look at the PE, but, relative to its own history and its peers, is it outrageously expensive even if the story's good? Just adds another layer of prudence.
Okay, this is really comprehensive now. Catalyst, story, timing, risk management, and fundamental health. So how do you put this into action, practically speaking?
Well, you can actually operationalize this. Build a master screener, maybe even in Google Sheets or something similar. It turns these ideas into a dynamic tool for finding opportunities.
So applying this refined framework, any specific examples pop out?
Definitely. Larson & Toubro fits that big orders theme perfectly. Massive order book. Something like 6.1 trillion. That's years of visibility.
Right.
And technically, it's in a solid stage 2 uptrend.
Right. Any others?
Cochin Shipyard. From the shipping building theme, again, strong order book, about 22,500 crore, lots tied to defense. Plus, they're expanding into ship repair, green energy vessels,
Huh?
strategic moves.
Okay.
And then there's PB FinTech, a classic PB setup example. Reported, 41% YoY profit growth? And it taps into that whole underpenetrated insurance market story in India.
We also noted ITC Ltd, right, as
Yeah.
one to watch for a potential demerger play.
Yeah, ITC is more on the track list. It needs that clear breakout above, say, 440 to really confirm a stage 2 entry based on this framework.
So the process is key.
Absolutely. Discipline is everything. Start with that 1% pilot. Only scale it to 4 or 5% if the thesis holds. And stick rigidly to that exit rule, the consecutive weekly close below the 200 DMA. It's about patience, precision, not impulse.
So listening to this, you should now have a really solid grasp of a systematic way to approach the Indian market, filtering for these compelling opportunities.
Which really brings up a fascinating question, doesn't it? Thinking about how applying such a structured, multi-layered approach, focusing on clear catalysts, the why, the how long, and disciplined exits, how could that transform not just, your investment decisions,
Yeah.
but maybe even how you tackle any kind of complex information overload in other areas too?